So continuing in Chapter 10, we have these wage bracket methods of withholding. And one is the percentage method tables, and the other method is the wage bracket method. And so the difference between these two methods is, I would say, complexity, just like using the income tax tables versus the schedule, a little bit more precise using the percentage method, but both are acceptable. This is found on page 1043, as I mentioned earlier in the earlier video. So when we look then at the percentage method tables for withholding income taxes, we see that it's broken down, these tables, by the frequency with which the employee is paid, as well as the filing status. So let's look at a semi-monthly employee who's married. And that means we're going to look at the third table on the right. And this functions very much like an income tax table, where you look for the income, and then you will find the appropriate income level, identify the appropriate row, and then perform the calculation as I demonstrated in an earlier video. So we know how to use these tables, and it gets us a little bit more accurate answer to the amount of withholding that we can expect from each of our paychecks, for example. But one thing I want you to notice is that when you look at the income, when you're using the percentage method, you're going to look at the amount of wages after subtracting withholding allowances. So we've already taken out the withholding allowances. Then we refer to the percentage tables. That's not the case down in the wage bracket tables for income tax withholding. When you look at the wage bracket method, you're going to be looking at gross income. So you look at the gross income, and then you'll look over to the number of withholding allowances claimed. And then the intersection in this matrix of the income and the number of withholdings is the amount you withhold. And again, it's based on the frequency of the payroll periods. All right, so continuing on then in our PowerPoint presentation here. When we look at what is withheld, we're all, or most of us, are familiar with the Federal Insurance Corporations Act, the Federal Insurance Contributions Act. And the Contributions Act, FICA, which is more commonly known by most of us, is Old Age Survivors and Disability Insurance, OASDI. And it's 6.2%, up to $132,900. For 2019, this is usually adjusted annually or adjusted frequently. And so $132,900 is the amount for 2019. What this means is that taxpayers who earn more than $132,900 no longer have any FICA withheld from their paychecks. So there is no withholding if you earn more than $132,900 for FICA. When you get down to hospital insurance or Medicare, that's 1.45% on all wages. Here there is no maximum. So everybody pays 1.45%. Now the employer is going to match both of these. So the employer will also pay 6.2% and 1.45% as well on the Medicare side. Additionally, there's a 0.9% for Medicare that's withheld from the employee's salaries and wages if those wages exceed $200,000. There is no employer match for this additional tax. So this 0.9% additional Medicare tax is paid only by the employee and not by the company, or not by the employer, I should say. In terms of tips, employees are required to report cash tips in excess of $20 to their employer by the 10th month after the month in which they received the tips. So if I received a tip working as a waiter in a restaurant on June 25th, I would have to report that by the 10th of July. Employers must withhold income taxes and FICA on employee tips. This, by the way, is one of the most underreported areas of the tax of income in the tax code. A lot of folks who receive tip income may not report the entire, or may misreport the amount of tips that they receive. Now, large food and beverage establishments have to allocate tips. So here, if an employee works for a large establishment, for example, more than 50 employees, then the tipped employees do not report tips. They will be allocated 8% of the gross receipts. So in other words, whether they receive it or not, they'll be assumed to have received 8% of the gross receipts, and then that will be allocated to them as income. Here, the employers are not required to withhold federal taxes on the allocated tips, but they are reported on W-2, so one way or the other, this income will be taxed. Employers must report payroll tax deposits, and so if, again, looking at this from the employer's point of view, the employer has to withhold the taxes from the wages and then send this money on to the government. And how often they send this money on to the government depends upon this look-back period. And so, for example, the look-back period determines whether the employer may have to send these or remit these funds to the government monthly or semi-weekly. And we use this look-back period of 4 quarters, starting with, and this is for 2019, July 1st, 2017 through June 30th, 2018. And if the monthly receipts were $50,000 or less, I should say if the receipts were $50,000 or less, then they have to report or remit these funds monthly. And if the look-back period indicates that there's more than $50,000 of income, then the employer has to report semi-weekly more often. In other words, they have to send those funds in more frequently on a semi-weekly basis. And the idea here is that the government doesn't want the employers holding large sums of money that belongs to the government any longer than necessary. So the schedule then for the weekly deposit, semi-weekly deposit schedules are the tax associated with payrolls that are paid on Wednesday, Thursday, or Friday have to be paid semi-weekly by the following Wednesday. Taxes associated with payrolls paid on Saturday, Sunday, or Monday, or Tuesday are due the following Friday. And then now all employers are required to use the electronic funds transfer payment system to make these deposits. So if you work in payroll or May 1 day, these are the rules regarding how often you have to pay the amount withheld from the employees' paychecks to the federal government. And then an employer who withholds $100,000 or more in taxes on any day during a deposit must deposit the tax by the next banking day. So here if we see an accumulation of withholdings, then that has to be paid on the very next business day by the employer to the government. And the employer becomes then a semi-weekly scheduled depositor for the remainder of that calendar year as well as the following. So that bumps them up to a semi-weekly schedule, even if this maybe was an unusual situation and they normally don't have the $50,000 through the look-back period. So when reporting the payroll, employers use Form 941. This is really a reconciliation between the payroll tax liability and the payments the employer made to the government. And this reconciliation, kind of like a tax return, is due by the end of the month following the close of the quarter. If there's a tax liability less than $2,500, however, at the end of the quarter, this amount can be paid when Form 941 is filed. And then for very small employers, so as not to overburden them with payroll tax reporting, they will use 944. For self-employed individuals, taxes are based on net earnings in excess of $400. You have to report on Schedule SE, and the important point to know here is that by being self-employed, you're required to pay all parts of FICA that is to say Social Security and Medicare. And you'll pay both the employee and the employer portion. Now you will get a tax deduction for half of that. The employer portion you'll be able to deduct because you're self-employed, and you wear two hats as the employee and the employer. And the employer part of this, you'll be able to deduct that half of the FICA that you've paid in. But you are required to pay both parts. Unemployment. The Federal Employment Tax Act is 6% of wages up to $7,000. So the first $7,000 of wages earned by your employees is subject to this 6% federal unemployment tax. Now, if your state has an unemployment tax system, the federal government will credit you at 5.4%, so that'll reduce your federal obligation to 0.6%. And you report this on Form 940 annually. Household workers on the payroll side, if you have household workers, they are considered employees subject to federal income tax, which goes to the federal government treasury, and FICA and FUTA taxes as well. So if you paid wages of $2,100 or more in 2019, then federal withholding taxes are withheld from these workers. Wages of at least $1,000 were paid to all household workers combined in any calendar year for 2018 or 2019. So you are required to withhold these taxes if enough wages are paid to your household workers. So Schedule H is used by the employer taxpayer and submitted with your individual tax return, Form 1040. And the taxes are due for household employees and paid when the employer taxpayer files a 1040. So Schedule H will help you to determine how much you have to remit to the federal government for the amount of taxes that should have been withheld by your household employees. Many of us are familiar with Form W-2. These are due by the employer to the employee by January 31st of the following year, tax year. And then Copy A is submitted by the employer to the Social Security Administration by the 31st of next year. And Form W-3 is a transmittal form that really summarizes all the employee W-2s prepared by the companies, and that's sent with Copy A for all W-2s by the 31st of January of the following year. So again, for those who aspire to work in payroll, this is a very important requirement that must be met by the employer. If there's a mistake made on a tax form, there's W-2C, and this allows the employer to send an updated or corrected W-2. There's also a W-3C transmittal of corrected income that has to be sent to the Social Security Administration. Now, Form W-9, many of us have filled this out when we began employment or started a job, and the employer is required to furnish the correct tax identification number, TIN, and for employees, that's most likely going to be your Social Security number. Any lack of compliance with this requirement will result in a $50 penalty. If it's willful, intentional, however, and this neglect of failing to complete this form, there's a potentially $500 penalty that could be paid. What does the form do, this W-9? Well, it certifies the tax identification number that the taxpayer is giving is correct. Certify the taxpayer is not subject to backup withholding, and then claim exemptions from backup withholding if the taxpayer is a U.S. exempt employee payments. If you're an employee and you're earning wages, you're earning a great deal of money from your savings or from your equity or debt investments, and you have to pay tax on those investments. Well, very likely you're having no taxes withheld from that income, that investment income, even though your employer is withholding taxes from your earned income. And if that results, when you do your tax return, in an underpayment of more than $1,000, then you'll likely have to start making estimated or quarterly payments in order to avoid penalties. This is also true of retirees who may have had jobs most of their lives, and then they had their former employers withholding their taxes from their paychecks, and so when they did their 1040s the following spring, they may have gotten a refund or they may have had to pay in a little bit. However, now that they're retired, if all of their income is from investments, very often there's no withholding of that investment income of taxes. So they would have quite a tax bill when they do their tax return. So to avoid that, the federal government requires these folks to make quarterly estimated payments. And these payments are due the 15th of April, 15th of June, 15th of September, and of January of the next year. So that is Chapter 10. If you have any questions, please let me know.